Thank you, Shiva, for the kind introduction. Well, as you will see, I'm the first academic presenting in this conference, and you can see that immediately from the slides. They are all black and white. The difference between slides of an academic is that the presenter adds very little to the slides, whereas in professional practitioners' presentations, the slide add very little to the presentation. That has been my experience. The issue I'm going to talk about is pension asset allocation, and in particular, I'm going to ask the questions related to whether accounting standards affect the way corporations allocate their pension assets between equity securities and debt securities. I will start with 3 anecdotes. The first one is Boots PLC, a UK company. In 2001, they liquidated all their pension portfolio and invested all the money in bonds, in UK bonds. 2.3 billion pounds of equities sold and reinvested in bonds. That was soon after FRS 17, the UK accounting standard, came out in 2000. And whether FRS 17 had something to do with this action is unclear. The company head of corporate finance rejected the view that FRS 17 motivated the switch, but from reading the press release at that time, for example, the Boots FRS 17 surplus 30 September 2001 was 300 million pounds pre-tax. Had we remained at the 30 March 2000 asset allocation, very much when FRS 17 was released, we would have been a 50 million deficit. So reporting a deficit versus reporting a surplus meant something for the company, even though the switching the portfolio from equity to debt securities was rejected as the motivation. So the head of corporate finance refers to the market value of the pension portfolio as something that determines the deficit or the surplus, and moving the assets exposed to bonds was the reason for the surplus rather than the deficit. This is the pension asset allocation of Sainsbury from 2002 to 2007. Although the change is not monotonic, because the market values of the portfolios have a significant influence on the relative percentage, you see that there is a clear move away from equities to bonds, and the portfolios are very different today relative to 2002. Sainsbury last week released the March 2008 preliminary reports. Their pension note at the end of the report does not include the asset allocation, so I don't know what is the asset allocation like in March 2008. The numbers will be available in mid-June, I suppose. This is GM. The last 3 years, US companies also experienced a move away from partial recognition pension accounting to full recognition pension accounting when FAS 158 was issued and became effective December 2006. So this is the asset allocation a year before and until a year after FAS 158 kicked in. And as you can see, a significant decline in the allocation to equity securities from 47 to 26%, and a corresponding increase in the allocation to bonds from 32 to 52%. Real estate and other investments were relatively stable, so you can clearly see a shift away from equities towards debt securities. Now, GM has a $120 billion portfolio, pension assets, so moving 20% from equities to bonds is a significant transaction. So the question is, do the accounting standards in the UK, FRS 17 and the adoption of IFRS in 2005, and the similar switch in the US from FAS 87 to FAS 158 have something to do with the shift of pension assets from equities to bonds. So in the US, until December 2006, SFAS FAS 87, the pension accounting standard requires, and to summarize FAS 87 into 4 or 5 lines is rather difficult, but the main issues are prior service costs were deferred and amortized, actuarial gains and losses deferred and amortized under the corridor method, the 10% corridor method, minimum liability requirements exist, and the pension deficits are partly recognized and partly off balance sheet. There is full disclosure. The notes are quite detailed, and you can see how much of the liability is off the balance sheet and what are the pension assumptions, the main assumption, and so on and so forth. So the disclosure is quite detailed. So you can characterize this regime as partial recognition, full disclosure regime in accounting. From December 2006, FAS 158, it becomes effective. Prior service costs are recognized immediately in income. Actuarial gains and losses are recognized immediately in shareholders' equity as other comprehensive income. Pension deficits, surplus is fully recognized on the balance sheet, no off-balance sheet liabilities. And again, there is full disclosure, so we can characterize this regime as a full recognition, full disclosure regime subsequent to FAS 158. In the UK, the situation is a little bit different. Until 2000, there was, I should say, partial recognition of the pension liability, but together with the vague disclosures, until 2000, it was very difficult to assess the real effect of defined benefit pensions on the financial statements. FRS 17 came in 2000. It wasn't recognized, wasn't adopted immediately because there was a delayed adoption, and then it was delayed by 1 year and again delayed. And at some point it was delayed until 2005 to coincide with the adoption of IFRS. So companies in the UK could adopt FRS 17, but they didn't have to. It wasn't mandatory. What was mandatory from 2000 was the full disclosure, very similar disclosure to US companies at the time, including asset allocation disclosures. So adoption of full recognition accounting under FRS 17 was done by several companies, but it wasn't mandatory. So we can characterize the regime, the accounting regime at that time, as a partial recognition, full disclosure regime. And from 2005 to until now, IAS 19 is the relevant accounting standard, and under IAS 19, prior service costs are fully recognized in income. There's full disclosure. Actuarial gains and losses are either fully recognized in shareholders' equity. Most of UK companies actually adopted this method, full recognition, and in shareholders' equity. But the corridor method is still allowed, and some UK companies, very few, elected to use the corridor method. For example, British Airways, and under the corridor method, some of the pension surplus deficit is off the balance sheet. We are going to eliminate the corridor companies from from our study. We searched the FTSE 350 UK companies. We found 7 companies that elected to use the corridor method, so we decided to eliminate them from the study. So basically, to summarize, US companies from 2006, full recognition, and the UK companies from 2005, full recognition. The difference between the US and the UK companies is that between 2000 and 2005, US companies had a full disclosure starting with FAS 87, but the new disclosures came in the UK from 2000 onwards. So that would be important in the design of the study. So this is basically the timeline that summarizes the previous 2 slides. From 86 to December 2006, US companies have full disclosure. So nothing happened in 2000 to 2005. The same disclosures that existed in the 80s and 90s were disclosed from 2000 to 2005. So we don't see any event until 2005 with US companies. The event is the adoption of FAS 158 in the US. In the UK, we see 2 events. We see a disclosure event from 2000 and 2005, and we see a recognition event from 2005 onwards. So the questions that we ask, we have 2 questions. The first one is, do companies respond to new pension disclosures by changing the mix of plan assets? That's the first question, and I'm going to motivate that question in a minute. And the second question is, do companies respond to pension measurement requirements, recognition, by changing the mix of pension assets from equities to bonds?
Really, another 7 minutes?
Sure. Consequences of pension disclosures, basically you're looking at greater transparency. So there's more information coming out, and employees, analysts have access to more accurate information. That could be the reason for changing the asset mix. Full recognition has other contractual effects. For example, shareholders' equity becomes more volatile, and that could have an effect on debt covenants, on performance evaluation, the study on dividend streams, on stability of dividends. So the study goes on to describe what are the disclosure effects and what are the recognition effects. And particularly, we're interested in whether balance sheet volatility should have an effect on asset mix. What can firms do in order to reduce the effects of the accounting standards on the financial statements? So first, they can terminate the pension benefit, the plan, by, say, selling it or closing it to new entrants, and a lot of UK companies actually did that. They can switch to defined contribution. That requires negotiation with employees. That happens as well. And they can also reduce exposure to market volatility by creating a case where assets and liabilities are actually matched. Pension liability is basically a bunch of zero coupon bonds. So if you find a set of investments that match the liability, and the liabilities and the assets move together, you eliminate the volatility on the balance sheet. So we have a set of predictions, and then we have a model that explains pension asset allocation based on a lot of prior literature. The impact on the balance sheet is one of the variables in the model. I'm not going to go into the results because of time, or at least not the entire set of results, but we are trying to estimate the cross-sectional relation between the allocation to equity and the other variables, and we do that in the disclosure regime and the adoption regime. The R disclosed and the R adopt basically look at the change in the allocation to equity in the disclosure regime and the adoption regime, and we basically expect that the beta 1 and delta 1 in those regressions, if they are significant, the impact on the balance sheet is the variable that explains this asset allocation. So the study focuses on the delta impact, after controlling too many other variables, for example, tax issues, funding levels, dividend payouts, leverage, and so on. Just to show you a bit of results, in this table we see the change in pension asset allocation during the UK disclosure period. And on average, you see an increase in the allocation to bonds, 154 companies, from 24 to 30%, and a small decrease in the allocation to equity. At the same time, in the US, there was no event. You see an opposite trend, a reduction in bonds and a slight increase to equities. If you eliminate the effect of market value changes, we call that index adjusted portfolios, you see a similar result. We don't see a dramatic effect, but we definitely see an average increase in bonds and a small increase in stocks, and we don't see that in the US. Then we do the same thing around the adoption of full recognition accounting in the UK and in the US. And if you look at the last two lines here, between say the year -2 and -1 and +1 and +2, you see a dramatic change in allocation to bonds and the reduction in allocation, the corresponding reduction in equities. There is some effect in US companies. The problem is that this study still does not reflect 2007. We are in the process of collecting the 2007 fiscal year data. Although we see something in the index portfolio with US companies, a reduction in the allocation to equity, we believe that once we put in the 2007 data, the results will be even stronger. So to summarize, we have some finding in large sample findings that show that the adoption of full recognition accounting is associated with a reduction in the allocation to equities and an increase in the allocation to bonds. Later on, we also estimate cross-sectional regressions and see that those companies in which the effect on shareholders' equity was larger switched more to bonds. So there is a cross-sectional association. We also find that companies with higher leverage also switched more to bonds, which is indicative of contractual effects. So to summarize, the study provides evidence in support of the argument that new accounting standards cause companies to switch from equities to bonds, perhaps to reduce the effect on balance sheet volatility. Thank you very much.
Increased disclosure would make managers more risk averse.
I believe that some of the results in the disclosure period are interesting in a sense that once you see more disclosure, you see a reduction in the allocation to equity by UK companies, and I believe that the increased transparency of the plan caused companies to be more risk averse in a sense. I definitely agree with that point. I think that's the motivation behind this change in asset allocation.
I was just wondering if you've thought about the maturity of debt to which companies switch, because there seems to be a disproportionate incentive to companies which longer-term debt. I mean, there was even a talk at the time that the inverted yield curve in UK is partly caused by the, especially index-linked segment, is caused by these switches of pension assets from equity to particularly long-term debt.
The maturity of debt, that could be a factor in explaining the, say, economy-wide switch. The entire sample on average switches more to bonds. And I'm sure it has something to do with what you're saying. But to capture that in the cross-sectional models, we will have to look at each company and measure maturity of debt. It's possible to do. We haven't done that. Yes, please.
What was the other category of their asset allocation there. I'm just concerned, how do you treat their investment in private equity funds? Because that seems like equity, but if it gets lumped in that other, I'd be concerned about that classification.
For example, in the Sainsbury case, there is a significant increase in the allocation to other, from 3% to 11%. I don't know what other is, because the data is taken from the financial statements, and the company does not provide a breakdown of the other. Sometimes there is a breakdown to real estate and other. But all companies classify the assets into equities and bonds, so the study focuses on the change in the allocation to equities without specifying what other is. So one particular error that we may have in the study is that if the 11% other is equity of some sort, perhaps even risky equity, then that could explain, or at least go against what we're looking at. So unfortunately, we cannot categorize the other as either equity or debt. There is some private equity investments in it, definitely, yeah.
One quick question on your control for funding ratios, because I think that's really quite an important issue here. Because at the same time when all these accounting rules changes were, you also had the equity market bubble busting, and in a way, from my experience of working in corporate pension management a while ago, one of the major drivers was really like this equity market going down. It was kind of a change in asset allocation was kind of a lagged response to market conditions. And how did you control for that? Is it kind of a lagged variable in your model, control variable?
Well, the funding, prior literature looks at funding as an explanatory variable for asset allocation. So controlling for funding is essential in these studies. In fact, controlling for funding is done by using a nonlinear association, by including funding levels and funding levels squared. And there are arguments why the association between asset allocation is like an inverted U-shaped relation. Companies invest more in equity when the funding levels are at the middle, and they in bonds when it's the middle, and they invest more in equity, for example, when funding is very low or very high. One argument about companies that invest in the US a lot in equities are those that are grossly underfunded because of the option value. The option of selling the pension plan to the PBGC in the US. That was raised as an argument. So we control for funding. The second point is, how do we measure the asset allocation, and how do we take into account the changes in the relative market values of equities and debt? We basically look at indices and look at market values at the beginning of the sample period, so as if there was no relative changes from 2000. So we eliminate the effect of market value changes on the study and look at and focus only on management actions. So we remove the effect of relative changes in equities and bonds from the study, and the results are very similar. So the big question is, how do corporations allocate assets? What happens if the market value of equity suddenly goes up and the market value of bonds goes down? Do they rebalance, and how frequent do they rebalance their portfolios? So we talked to a lot of pension experts in the UK, and nowadays rebalancing is done more than once a year, and it is done even when the relative values change. Okay, so if the equity value goes up, there will be a rebalancing if your policy is to keep, say, equities at 50%.
We need to move on to the next.